This is a full in-depth course on the Forex market with a total of 6 lectures. This course is developed for those who want to become professional traders. Here we will introduce the contents of the course. In Lecture 1, we will talk about the Forex market, financial centers, trading sessions, and volatility zones. In Lecture 2, we will discuss Forex currencies, cryptocurrencies, commodities, indices, CFDs, and ETFs. In Lecture 3, we come to pips and lots, spreads and commissions, margin and leverage, rollovers or swaps. In Lecture 4, we will look at Forex brokers, accounts, orders, and platforms. Lecture 5 covers technical indicators, chart patterns, high-frequency trading, and flash crashes. And finally, Lecture 6 looks at advanced topics on Thomson Reuters and Bloomberg platforms, Delta One desks and dark pools, as well as LIBOR and Euribor. Lecture 1 has 4 parts: the Forex market, financial centers, trading sessions, and volatility zones. In Part 1, we look at the key players in the Forex market, the investment banks, central banks, institutions, and brokers. In Part 2, we cover the 3 types of Forex financial centers: international financial centers or IFCs, regional financial centers or RFCs, and offshore financial centers or OFCs. In Part 3, we come to the Forex trading sessions in Pacific, Asia, Europe, and America. And finally, in Part 4, we look at the different Forex volatility zones with overlaps between the British pound, euro, and US dollar, and a second overlap between the Australian dollar, New Zealand dollar, and the Japanese yen. Lecture 2 has 5 parts: the Forex currencies, cryptocurrencies, commodities, indices, CFDs, and ETFs. In Part 1, we cover the 3 main groups of Forex currencies: the majors, minors, and exotics. In Part 2, we look at the 4 most traded cryptocurrencies: Bitcoin or BTC, Ethereum or ETH, Litecoin or LTC, and Ripple or RPL. In Part 3, we come to the most traded commodities such as gold or XAU, silver or XAG, crude and Brent oil or XTI and XPR. In Part 4, we have the most traded Forex indices such as the Dow 30, Nasdaq 100, S&P 500, FTSE 100, and DAX 30. Finally, in Part 5, we come to contract for difference or CFDs and exchange traded funds or ETFs. Lecture 3 has 4 parts: pips and lots, spreads and commissions, margin and leverage, rollovers or swaps. In the first part, we talk about 3 types of lots: standard, mini, and micro. We will also look at trade sizes of units, ounces, and barrels. In Part 2, we cover the spreads and commission structure for floating, fixed, and zero spread accounts. In Part 3, on margin and leverage, we discuss terms such as used margin, free margin, margin level, margin call, and stop-out level. Finally, in Part 4, we discuss rollovers or swaps of 2 types: swap long and swap short. In Lecture 3, we also look at the 10 types of equations used in the Forex market. We will do a lot of examples and go in great details to understand how critical they are while trading. Every professional trader should know the following equations for profit and loss, equity, margin, margin level, free margin, margin call, stop out, spreads and commissions, and swaps. Whenever you use your MetaTrader platform, on the bottom of the screen, under the Trade tab, you will always come across these terms. That's why we will look at exactly what they refer to and how they are calculated. In Lecture 4, there are 4 parts: Forex brokers, accounts, orders, and platforms. In Part 1, we look at how brokerages are structured through a liquidity chain, platform setup, trade models, incorporation, and licensing. In part 2, we discuss the different types of accounts offered by the most well-established brokers such as Forex Time or FXTM, Forex Capital Markets or FXCM, the XM Group, Iron FX, and FX Pro. In part 3, we cover the types of orders such as market orders, take profit and stop loss instructions, limit orders, and stop orders. Finally, in part 4, we come to trading platforms such as MetaTrader and its MetaQuotes language, CTrader along with CAlgo. Lecture 5 has 4 parts: technical indicators, chart patterns, high-frequency trading, and flash crashes. In the first part, we discuss the most used indicators for trading. The trend indicators such as moving average or MA, average directional index or ADX, parabolic SAR, moving average convergence divergence or MACD. Momentum indicators such as relative strength index or RSI and stochastic oscillator or SO. Volume indicators such as accumulation distribution line or AD and money flow index or MFI. And finally, volatility indicators such as Bollinger Bands. In part 2, we come to the different types of chart patterns such as double top and bottom, wedges and pennants, cup and handle, head and shoulders. In part 3, we look at high-frequency trading and major US-based HFT firms such as Virtu Financial, Tower Research Capital, IMC, TradeBot, and Citadel. Finally, in the last part, we cover flash crashes such as Dow Jones Industrial Average in 2010, GBP USD in 2016, JPY USD and Australian dollar versus USD in 2019. In Lecture 6, we have 4 parts: financial data vendors or FDVs, Delta One desks and dark pools, LIBOR and Euribor, and a bonus series. The first part covers platforms by financial data vendors or FDVs such as Bloomberg Terminal and the Reuters Icon. We also look at the comparison table of FDVs. In the second part, we look at Delta One trading desks or DOTDs and dark pools. We will also go through the Forex fix mechanism and rogue traders. Part 3 is based on the London Interbank Offered Rate or LIBOR and the Euro Interbank Offered Rate or Euribor. Part 4 is included as a bonus series where we will discuss historical events such as the Silver Thursday and Black Wednesday.